Hello, everybody. Luke Gromen, FFTT. Hope you had a great weekend. Before we jump into this week's discussion, wanted to highlight that this is bonus week for tree rings. We do that twice a year, so check out our website, FFTT-LLC.com, for more information. With that, we're going to jump right in. First question from SK. What are your latest thoughts on the timing of a Fed pivot? I still think they're done hiking. You've got the next Fed meeting November 1st and 2nd. Failing an explicit pivot before then, I'm not sure people realize how bad this is likely going to get over the next month to 5 weeks. You're seeing sovereign credit risk in the West accelerating rapidly as we speak, and I think that's likely going to continue. FX market risk and sovereign debt risk. So, with the second question from BT, what is it going to take to get the Fed to pivot? 9:30, September 30th is Friday, and your predictions are playing out. As a reminder, what we said is we thought the Fed would be forced to stop raising rates by the end of 3Q 2022, which we wrote back in April, which was seemed pretty inconceivable then. It's seeming less inconceivable by the day. Easy for me to say. Fed seems willing to let this run into depression. Do we get a credit event? Junk is off less than treasuries. Will stocks crash regardless of pivot at this point? We are getting a credit event, I think, as we speak at the global sovereign debt level. Western sovereign default risk, I think if this keeps going at the pace of the last 2-3 weeks, I think you're going to start to see concerns about Western sovereign solvency within a few weeks at this pace. And then it starts to get interesting because Western sovereign debt is the risk-free asset that underpins the banking system. And so while we've seen stocks down 10% the last 2 weeks in total already, I think we're getting into a situation where the risk of an outright crash of sorts is elevated until the Fed aggressively pivots and up to and including some sort of either de facto or outright QE. From Cal, will junk debt be what breaks the system causing a Fed pivot? What are your top 3 things to watch as signs that the system is breaking? The number one thing and probably the number 2 and 3 things, quite frankly, are U.S. Treasury market dysfunction. I think that is what is going to break. And I think, quite frankly, when you look at we highlighted this last week in tree rings, when you look at the U.S. interest coverage ratio, right? Look at U.S. True interest expense, which are entitlement pay-goes plus Treasury spending relative to U.S. tax receipts. It's really just an interest expense versus EBITDA metric. And if you look at any corporate, anytime their interest expense is more than their EBITDA, they're a high-risk credit. And that's where the United States government is back to that position, probably right about now at this moment. They were able to get on the good side of that metric by virtue of the everything bubble in 2021 that drove a tax receipt bubble, but with the everything bubble now deflating, the tax receipt bubble is deflating as well, and you're starting to see signs of that. And so, to me, it really all comes back to the Treasury market, and what the dollar is doing is a leading indicator of worsening Treasury market dysfunction. So the more the dollar goes up, the more Treasury yields are going to go up. Foreigners, as a reminder, have in total $7.5 trillion of treasuries that, in theory, they can sell to defend their currencies, to get dollars, to buy their own currency, to defend their currency, or to buy energy. So Treasury market dysfunction is the number one thing right now, I think, to keep an eye on. From TS, is the UK facing a genuine currency crisis? Yes, they are. They are likely going to face falling currency, rising energy costs, rising rates, wash, rinse, repeat until they either accelerate their own domestic fracking. I know they repealed a fracking ban. I don't know that they're making a lot of progress on it yet. Or they find some other miracle energy solution, or the UK reaches a détente with Russia, and Russia then allows the UK to buy energy in their own currency. Or the UK economically collapses, unfortunately, either out of significant rate increases to try to stop inflation or insufficient rate increases due to runaway inflation. So they're in a pretty tough spot. From AJ, voters swinging to the far right, insane energy policies, dysfunctional EU leadership. What's the end game for Europe? To me, it's pretty similar with the UK. You either need an energy miracle, which basically is sort of nuclear fusion commercially rolled out by Christmas, or the EU needs to go to Russia, reach a détente, agree to buy energy in their own currency, or again, you're going to be facing the same sort of economic collapse that the UK is facing, either by significant rate hikes driving economic recession and resulting economic crisis, financial crisis, or by virtue of not raising rates enough and you get runaway inflation as you get this feedback loop with energy. It's important, I think, to highlight, I retweeted this over the weekend, Paul Krugman was pointing out in the case of the UK, it's not a classic currency crisis because the UK or the EU don't owe debt really in another foreign currency. And that's nominally true, but from a pragmatic standpoint, energy is serving as the foreign currency that they both owe and cannot print. Let's see, next question from JM. With investment grade bonds breaking down through important support levels, please touch on the importance of collateral in the global financial system and signs to look for which might hint at a collapse. So for me, I would watch gold. When gold starts to rise in dollar terms with rising real interest rates and rising nominal interest rates, that's going to tell you that the risk of systemic collapse is rising. Basically, at that point, you're going to be watching. It will be a sign that people are getting out of sovereign debt into gold, concerns about sovereign debt solvency. From Kay, is the UK the next Greece? We wrote to our clients on September 7th that the pound, the euro, and the yen to us were very much akin to the Indonesian rupee and the Thai baht from the 1997 Southeast Asia crisis, that they would experience currency crisis again, not in the classic sense that they owed foreign currency debt, but that they needed to import significant amounts of energy and that they could not print that energy unless they agree to buy that energy in their own currency from Russia and others. That would require them to de-dollarize their energy imports. That would require a reordering of the post-war global order, basically turning away from the United States. Otherwise, they are likely going to experience currency crises akin to a Greece, akin to what Southeast Asia saw in the late 1990s, which is unfortunate. From DR, how are you factoring in ESG into structuring your portfolio? This is only half tongue-in-cheek. I'm planning for energy shortages because that's what ESG is going to do. We're seeing that in Europe. You're seeing that in the UK. I've been early. However, I bought 2 wood-burning stoves in 2009 or 2010. I bought solar panels in 2010, 2011. I've got a backup generator that's on a natural gas line. Basically, if a bald guy in Cleveland had been planning for 5 to 10 years for much more expensive energy, it wasn't unforeseeable. The policymakers that in Europe, in the UK, elsewhere, it should have been very obvious to them as well. They chose poorly. They listened to the wrong people. And so it is what it is. In terms of other ways, I'm factoring in ESG. When you see us write about electric vehicle metals, I think that is ultimately a nod to ESG. I've also been I'm looking at making an investment into a electric transmission and distribution private equity investment. I continue to think electrical infrastructure, related metals and commodities will do well. Industrial companies will do well over coming years. But again, in the short run, basically what we're watching in global sovereign debt and FX markets is a boulder that has been started downhill. And unless you get a real rule change from the policymakers, a substantial rule change, once that boulder gets rolling, it's really hard to stop. And that's, I think, what we're seeing. So with that, is it for today. Again, we're in bonus week for Tree Rings. We do it only twice a year. So if you're interested, Tree Rings, again, by way of context, 10 most interesting things. We write it every Friday afternoon. tie into, have a brief synopsis to each thing about what grabbed our attention about those things, how they're making us think about the world, either in line with how we were thinking about things prior or differently. And we've gotten great feedback on it. So check it out, FFTT-LLC.com. Otherwise, thank you for joining me, as always, and everybody have a great rest of your week. We'll talk with you soon. Take care, everyone.